Okay, so I think I'll start here. Of course, if anyone else joins, yeah, missed the first few slides, but I'll make the slides available at the end of the second lecture. In addition, the course is being recorded, so people can catch up if they've missed anything on the recording. So first and foremost, thank you very much for joining me today, and yeah, welcome to part one of entrepreneurial finance. So I'm very pleased and honoured to be presenting this course. And throughout the course, if you do have any questions, there is a chat or a Q&A function at the bottom of Zoom, so feel free to shoot off any questions. I'll try monitoring that throughout the session. However, yeah, if it's sort of a burning question, I might answer it straight. Well, throughout the course of the lecture. Otherwise, a number of questions I'll sort of leave to the end, and I'll try and answer as best as possible all your questions if you have any. Of course, if it's something that I need to look up on, I'll have 24 hours till tomorrow's lecture, and I'll do my best as well to answer it correctly if I can't answer it on demand. Okay, so I'm just going to share my screen now, and we can start. Let me just put this into full screen. There we go. Okay, so yeah, today we are looking at entrepreneurial finance. If you are thinking of or you are in the middle of an entrepreneurial journey, this will obviously be one of your concerns, and maybe if you've come from a more technical background, this is a good job that you're attending this, because it's obviously a necessary part of business and will become part of your journey as well. So in today's lecture, we will look at the following topics. So, what is entrepreneurial finance, the importance of finance to startups, various sources of entrepreneurial finance. We'll look at equity finance, debt or bank finance, grants, and a number of alternatives. Then in tomorrow's session, we will look more practically at how you make an assessment of the financing you need, what you need to build into your plan for obtaining financing, how you even assess how much you need, and what sources you should look for, and then what really investors or the sources of finance are looking for, and how to present your concept. I think I actually forgot to also introduce myself. So I'm Pietrangelo. I'm the manager and partner of Lira. We're an advisory for startups and scale-ups. So we deal directly with entrepreneurial finance, helping them decide their best path to funding their venture. And we also help with the actual preparation of the documentation that these companies require to present their solution to investors. I haven't taught for a long time, actually. I did actually used to do a bit of teaching back in Rome after I graduated. So excuse me if I'm a bit rusty, and do let me know if you would like me to slow down or speak a bit more clearly at some point. I'll try my best. Okay, so to kick off, we will look at what is entrepreneurial finance. So, as you may know, innovation and inventions are very important to economies, and this is why governments put a lot of stimulus and importance in generating new ideas, as these are the drivers of new growth potential, with GDP growth potential and also job growth as well, which is a key part of government policy. As you can see, with America and the emergence of all the big tech companies like Google, Facebook, Amazon, etc., the innovations that they have developed have added a huge amount to US GDP and jobs as well. In fact, global jobs as well. Europe is a little behind, but there is stimulus and will to change to that position. So these pictures seem like they've come out a little pixelated. But what I want to show here is an example of these rags to riches or against all odds stories that fill books, magazines, and our imagination of entrepreneurs. I mean, for most entrepreneurs, the actual story and the actual time of raising finance and this process of entrepreneurial finance is a very grueling story. But there are a number and actually lots of successful cases of entrepreneurs who have successfully gone through this process. And here, okay, I've given the cream of the crop. We've got Richard Branson here, from Virgin, Larry Ellison from Oracle, Joy Gendusa from Postcard Mania, Duwon Chan from Forever 21, Sarah Blakely from Spanx. Here we have a very old picture of Edward Carnegie from the Carnegie Steel Company. I'm sure you all know this one, Steve Jobs. Maybe this one you won't quite recognize, but it's Mark Zuckerberg back from 2004, when he was still a student at Harvard. And on the right, we also have Elon Musk. So these are all people who have done it and gone through that journey. But I mean, the real question is, how did they get there? What is the journey that they may have taken? There include many factors within this journey. Of course, the actual solution itself that they were developing, the market they were in, but the financing was also an important part of their journey. And in this short course, we will focus on the financial story of entrepreneurship. This includes the importance of finance for new ventures, the forms of entrepreneurial finance, and then, as I said, tomorrow we'll look at choosing the right finance and what financiers want to see. Okay, what exactly is entrepreneurial finance? So I mean, finance itself is the art and science of money handling and capital management and all the things that go in between. I mean, finance is important for business because it's lifeblood, really. It is, unfortunately, the way we measure business, and it's the tool that allows businesses, well, one of the tools that allows businesses really to grow. And it is in, as it puts it, it's in all activities of business. There's not really an activity of business that doesn't involve the finance department. The ultimate goal of finance is to to achieve the highest efficiency of funds. So that means to make the most profitable type of venture. And then therefore financial management is the firm's responsibility to plan, to acquire and manage capital, to efficiently run the business, as well as to grow it and further invest it. And now I'm going to put a little reminder here, and that although there are many other reasons why a business might exist, to create a positive social return, to fuel a founder's desire and for personal passion. But in the case of most businesses, not non-profits, but in most businesses exist to make profits, and this is an important premise for any budding entrepreneur. It's so obvious, but without profits, you really have no business. So that's some sort of what finance is, and entrepreneurial finance sort of sits as like a sub set of corporate finance, and within finance in general. So corporate finance specifically deals with funding sources, capital structuring, so your ratio of debt and equity, and investment decisions. The objective of corporate finance and the objective of business, in a sense, is to be profitable, and the reason to be profitable is to maximize shareholder value. Profit, of course, increases both the value of the shares in the company, so the value of the ownership a person has in the company, but also if it's a dividend-paying company, the value of the annual payment paid to the shareholder. So entrepreneurial finance is the application of these sort of corporate finance principles in the domain of specifically new and small privately owned enterprises. And entrepreneurial finance deserves its own field, let's say, because, well, let's say new ventures are very different from established corporates. The needs, the nature, dynamics of a new venture are completely different. I mean, first and foremost, they are a lot riskier than established enterprises that have proven business model, proven markets, maybe assets on the balance sheet. A startup is often, well, at its beginning, just an idea with a potential solution, and over time that idea develops and maybe it becomes more proven or more probable that it will make it on the market, but still they're inherently more risky. And also entrepreneurs are a very different set of people than conventional business managers. But nevertheless, entrepreneurial finance involves the same elements of corporate finance. It's about planning, developing, starting up, operating, growing, maturing value, and eventually harvesting or selling entrepreneurial business projects. Okay, so so what are the main differences with corporate finance? I mean, first, entrepreneurial finance is characterized by significant issues associated with information asymmetries between startups and finance providers. What we mean by information asymmetries is that there's a balance between one, entity and another entity in the actual knowledge about the company. So, for example, corporates have financial statements that are audited. They're publicly available sometimes. There's at the end of the year, a large company does an annual sort of statement and report that is attached to those statements that discusses all the activities within the business. But also, you can clearly see from looking into a company how it's operating. A startup doesn't have any of these. If you're 1 year old, you don't have a balance sheet. You won't have a profit and loss or a cash flow statement, and you also won't have tangible or intangible resources. So that the way for an entity to assess whether you deserve financing or not are very different to corporates. So they end up making assessments based on other sort of features of the startup. So your business plan, the team, the product in itself, but they're all hypothetical. So as we said before, it's a much riskier area of finance. As a result, stronger contracts, different forms of finances is used. There's greater active involvement from people who generally invest in startups compared to, for example, with corporates, they might go to banks or issue bonds or put themselves on public markets where people trade and buy these instruments, but they don't actively really get involved in the company. Investors in startups show a lot more interest in the actual investments they make. And different to a corporate finance is made in rounds. So where a corporate might say, this year we need 10 million, 100 million. If a startup lasts 100 million, they won't get it. This will be broken down into certain milestones, but on reaching those milestones, they're able to obtain further funding. This is because at reaching a milestone, a company normally reduces its risks, but also increases its value. In entrepreneurial finance, we address how much money can be raised, how much money actually should be raised. You don't necessarily need to go for all the money in the world. You should look for a specific amount that you need to achieve your set milestones and deliverables. A question as well is when should be money raised? So you've always got to be thinking in the future as well, and that until you're profitable, for sure that burning question should be, when is this money going to run out? And there should be a lot of forward thinking to make sure that you end up not burning all your cash and then having to have periods of zero growth or zero improvements in the company while you're desperately looking for more cash. What are the sources of funding that should be approached? And of course, you should also evaluate which one is the best one for your startup. What is my reasonable valuation? What is a reasonable valuation from my startup? So how much is it worth, and how much should I be giving away? This is one thing that I would really address in these slides, because they say it's more than an art, more than maths. It's kind of based on how much you might actually think your startup is worth, especially if you have reached very few milestones. And then how should funding contracts and exit decisions be structured? So it moves us on to the first question, which is, where's the money? So I do know what situation everyone is in here, but you may be in the situation that you've discovered a breakthrough innovation. Or you might have discovered a unique business opportunity, or even better, you have a breakthrough innovation with a unique business opportunity. At this point, you might be thinking of commercializing your technology, or you might be at the point where you want to investigate the potential technology and business opportunity and look at ways of potentially commercializing it or allowing other people to pay and use your innovation. But yeah, whatever position you're in, unless you're particularly fortunate, a concern of yours will most certainly be where is the money? And in fact, along your entrepreneurial journey, this will be, say, a repeat question. And you know, as we said earlier, this is because money, unfortunately, is that all important aspect of business, and you know, business cannot survive without money. So you must always be thinking about this question. Okay, so the financial needs of startups. So, for example, the startups exist because they have discovered a solution, innovation to a business opportunity. So here I wanted to find the worst possible invention in the world, and it came up here with an air-conditioned shoe. So here we have this guy here who's looking to commercialize his fantastic discovery of air-conditioned shoes. And you know, he wants to, you know, become profitable by commercializing this innovation and offering it on the market. However, this say here is a render or just a prototype, and you know, before he will become break even or even best profitable, he has a number of technical and commercial risks to overcome. These technical and commercial risks might be, for example, furthering the technology development to make the innovation foolproof and build a technological moat around the solution. So it is hard to copy. So he might have a prototype of the shoe, but he needs to make sure it's comfortable, make sure the air conditioning units function, they don't run out of battery, or all these sort of technical aspects that that might need to be investigated before the product becomes something that someone would want. The technology must also, or innovation must also be made commercially viable. So yeah, these might include, for example, obtaining certification, regulatory requirements, making the user interface, making it, you know, manufacturable at a correct price point. So making it, you know, economically interesting for the customer. You might need to demonstrate and validate the technology with a number of early testers. These might be pilot trials, paid pilots, pre-commercial trials. So this would be to show that the solution works, that it's liked on the market, and therefore, you know, he can prove to himself that, you know, people will actually be interested in the issue. He might want to protect his intellectual property, you know, make sure that, you know, no one's going to steal the concept and start commercializing it on the market. And might need to develop marketing and sales channels to generate demand, with the long-term ambition to eventually reduce the cost of acquiring a customer and maximize the lifetime value of each customer. And he might need to establish a supply chain to fulfill the demand. So he might need to find manufacturers when his shoe becomes very popular that can produce, you know, thousands of units of these shoes so he can become fulfill those orders and become profitable. Here you should focus on reducing also the eventual cost of the shoe to maximize the efficiency of the business. So for a startup, there are still many activities that need to be done to actually get to the market. And most important, what this question brings us to is most of these activities will require significant financial resources, and these are sort of costs that the startup might incur in developing this technology. So obviously there's personnel costs to consider. That could be yourself, or that could be your technical development staff. But also, you'll also want some commercial staff on your team as well, who can sell the technology, and maybe even someone on finance as well to help you in raising finance. Materials and equipment to actually produce your technology at a very early stage. The cost to produce one unit might be much more expensive than it will eventually cost, because you'll go through multiple iteration cycles, but you also won't have an optimized cost of goods sold. So there'll be material and equipment resources to consider. Travel is something for sure to consider. Going to maybe not at the moment, but in normal working periods, travel to meet customers, to meet suppliers or subcontractors, or to just attend trade fairs and events and start getting to network and create those potential commercial leads. There'll also be contractors, consultants, your accountant, your lawyer, potentially outsourcing technology providers if there's something you don't have in-house. Maybe you'll be considering a collaboration with a research organization as well. So you'll have to budget in that as well. This would include agreements with universities. There's also onboarding costs as well. As you further develop your product, you might need to do training, on-site visits, customer relationship management as well. The sales process can be very expensive as well, especially at the beginning. Online and offline marketing to promote your product. Maybe you'll do tenders for supply chain partners, and meetings, putting together agreements as well, testing the delivery of the product, and there are many other costs that a startup will incur in its journey to commercialize an innovation, to get break even, and to eventually get profitable. And all these must acquire for, and of course must be accounted for, and of course all of these require financing. Someone asked, what are the costs involved in agreements with universities? Well, I mean, what are the costs involved with all of these? I mean, it really depends on a lot of factors. In fact, we'll do this tomorrow actually in building your financial plan, and in building your idea of how much you need. You should also fund a small period of time where you do sort of your financial feasibility study, where you look into all the exact costs that you can build up into your budget. And here the best way is of course to speak with your universities. But I mean, it depends, if you're using personnel or if you're using resources at the university, what resources are you using as well? personnel in universities can range to quite a high price if they're contributing to your project. And also, as you know, some of the equipment in universities are considerably expensive if you need to use them. So yeah, as I said, it depends on building a good financial plan. You need to have solid assumptions, and the best way is by actually interacting with who you're thinking of collaborating with to get a very close cost estimate. Investors, if they see assumptions that aren't backed in any way, you'll lose credibility in your plan, and they'll spend more time asking about why you didn't make assumptions or where you've made your assumptions from than actually a constructive business conversation about giving you money. Okay, so this is a famous concept, and it's called the Valley of Death in the development curve. So undertaking all these activities may move your solution to commercialization and break even. However, if you're unable to fund these activities, you may find yourself in this valley of death here. And this is the financing gap that new technologies and ventures face when they have not proven their commercial application or usefulness. So, if you're based in a university, you may have had your first financing for your innovation, or your innovation may have spun out from some early stage research, or some research you've done at university, and so that was funded maybe during your PhD or with sort of a university grant, and now you want to start developing or commercializing your innovation. But as we said, all of these activities, and the further you go along with commercialization, the more expensive these activities will become. You start with doing a small proof of concept or feature development or prototype build. It's slightly cheaper as your prototype gets bigger, or you get closer to commercialization, close to a commercial version of the product. It gets more and more expensive, especially if you're in an industry, for example, such as healthcare, where you're doing medical trials. In those cases, your product first needs to receive lots of certification, and then you need to just do lots of demonstration and testing as well. And funding those trials can become very expensive, and you might find yourself at this point where you're like, well, we now still need 10 million, and where are we going to get that funding from? So you might have a very exciting product, a very exciting business opportunity, but you have this big funding gap. But and as it says, your product might potentially be successful, but you don't have the money, and until you get the money and then the revenues actually start coming in, well, your business eventually becomes successful. Unfortunately, to know, this isn't the only valley of death. Companies actually often face two valleys of death. The first one is for early stage ventures, funding their development of proof of concepts and prototypes prior to revenue generation. The second one will be for maturing ventures that require significant levels of funding to realize growth potential beyond initial revenue generation as well. So that's where you might have developed your first product. It's interesting. It's producing revenues, but you might still be making a loss, and to reach high level amount of profitability or high level revenue growth, you really require funding in infrastructure or in scaling up your sales or your team. However, in this series, I'm gonna focused on the first venture, sorry, the first value of death, where you've developed the first prototype with a small amount of funds, say, or even in your own time. However, you need that money to be able to take yourself to the market and actually start creating revenue. So now, before we just move on into looking into the sources of finance, I'm just going to bring a quick reality check. So yeah, bring us to reality with this quote from Paul Graham, the founder of Y Combinator. He's a programmer, entrepreneur, venture capitalist, and author. And yeah, he co-founded Y Combinator, which is a very influential startup accelerator and seed capital firm that's been used to launch incredibly over 2,000 companies, including many famous ones such as Stripe, Airbnb, Coinbase, Instacart, Dropbox, and Twitch. And he says this quote, that raising money is the second hardest part of starting a startup. The hardest part is making something people want, but the second biggest cause of death is probably the difficulty in raising money. Fundraising is brutal, so be prepared. But we saw there's a group of entrepreneurs. They made it earlier, and in fact, don't get put off by one rejection. There's the example of Howard Schultz, who started Starbucks. He was actually rejected by over 200 investors when he was looking for funding, but eventually he did get it. Okay, and yeah, why is entrepreneurial finance so tough? As we said before, innovation and invention drive economies. So you should assume that it should be quite okay to raise finance. And in fact, startups play a key role in modern knowledge-based economies. So, for example, the economies of Europe, startups are very important for jobs, innovation, and productivity growth. In fact, not startups, but small enterprises are 99% of all enterprises in Europe and employ 55% of people. And over the past 5 years, these small enterprises have created 85% of new jobs. So they're very important. So you wonder why is it so difficult for new companies to raise money. And the problem with a lack of finance is that it limits enterprises operating at their full potential and their growth prospects. So access to finance is actually paramount or very important to startups reaching their potential, maintaining their competitiveness, and driving economic growth. Of course, this finance as well also has to be made on reasonable terms as well. So despite this, most startups suffer from financing constraints, which limits their growth and threatens their survival. So while established corporations can raise funds from, say, capital stock on the public market, debt from banks, or from issuing bonds, or allocating internally generated funds, these options are not available for startups. In fact, they've become increasingly less available for startups as a result of the 2008 financial crisis and the implementation of Basel II regulation, which limits sort of the loan portfolios of banks. So it's made their lending capacity much smaller, and it's made them more risk averse. And yeah, actually, this hasn't just affected startups. This has also affected SMEs in general. And the main reasons startups really face difficulty in raising finance is because they lack internal cash flows, so proven revenues or profitability. So they don't produce profit, and it's not feasible for the startup to be able to pay back a loan. Startups also don't have any assets to act as guarantees or collateral to finance in. They lack a company history. So with a very, as we said, a big company, you can see what it's done in the past, and you can see what the founders have done. So you can easily make a judgment of how well they will behave in the future. Again, there's information asymmetries. So there's not the best information available about a startup, and there are agency problems as well. So that's regarding conflicts of interest within starters. The founder is often also the owner as well, and they might take greater risks than a corporate. Other reasons as well is the cost of financing. So raising money for startups can be very expensive. If they do get loans, they're very expensive. But also, if you look for other forms, as we'll see, like equity, they can also take a big share of your company. The location, unfortunately, for startups matters. The closer you are in an ecosystem where there are venture capitalists, where there are angel investors, means the more chance of actually getting finance. Unfortunately, this does concentrate the economy in areas where there's better access to finance, and leaves those without such without such access economically impoverished. For example, in the EU, half of business angel investment is concentrated in only 3 member states, and 90% of venture capital investment is concentrated only in 8 member states. So, I mean, here's advice as well. If you're thinking of starting your startup, if you need, and if you know that finance will be an important part of your journey, do actually consider location. Unfortunately, the location where most VC and startup finance does happen are expensive locations, but it is important to be in an environment or ecosystem where venture capital or other forms of startup finance is available. And also the competitive nature of finding financing. So here's just a few examples. The average investor or VC may hear 750 pitches a year. They might then actually evaluate or read the business plans of 200 companies, and eventually invest in only 3 or 4 of them. So in raising finance, that gives a chance of success of 0.4 to 2%. As it's been said, you have a much better chance of entering Harvard Business School and graduating into a larger salary than getting funded. That's something to really consider when you are thinking of your startup, is the chance of success. And I don't want to put anyone off, but it is slim out there, and you have to be very serious if you want to really follow this and be aware of that risk as well. And that's why Paul Graham said financing is brutal. And the reason for this is that investors in VC have limits on the time and money they can invest. Each deal takes an average of 83 days, which includes 118 hours of due diligence. And you might be out there competing against hundreds, or if not thousands, of other startups as well, who are equally convinced in their idea and equally convinced in their business opportunity. Okay. So another reason, of course, is that startups are risky, and not everyone is that interested in putting their money in such a risky business. It's definitely not for the risk averse investor. As I said, on average, good plans, good people, and good businesses succeed only 1 in 10 times. And this is because there are many components to a company's critical to a startup success. For example, the funds available it has, the capability of management, if the product development goes to plan, also the outsourcing, if it goes to plan, the competitors behave as expected, the fact that customers might actually want the product, the pricing of the product, and for example, the intellectual property of the product. And so, for example, the best company might have an 80% probability of succeeding in all of its factors. But as you see on the image on the right, even if you have 80% in all of these factors, with these odds, the eventual probability of success will actually be less than 27, because failing to execute on any one of these components can torpedo the entire company. And in fact, if one of these components, just one of them, drops to 50% probability, the overall success of the startup drops to 10%. So it is a risky business for any investor. Okay, so and now then move on to the actual sources of entrepreneurial finance. Okay, so despite all that doom and gloom I just said about the difficulties startups face in accessing finance, there are a number of entrepreneurial finance solutions out there, in fact, there are a number of emerging solutions as well, and this sector is in fact growing. A number of emerging solutions include, for example, accelerators. You might have heard of incubators, crowdfunding, peer-to-peer lending, family offices, etc. And in fact, these new players have also emerged as a result of the difficulties faced by entrepreneurs and startups in raising funds, particularly after the 2008 financial crisis. They've also emerged due to technological trends, most notably, of course, the internet and social media has allowed the span of raising investment to increase. This has been particularly influential on the emergence of crowdfunding, but also peer-to-peer lending. You just need the internet to present your idea and to raise money from investors. Globalization, of course, has allowed startups from different areas, despite saying location matters, has allowed startups from different areas to raise money from more areas of the world with more capital available to invest, and regulatory changes as well. So, for example, again, Basel II and III made small firm financing more complicated and expensive, and startups have now little chance of raising money from the bank. So it's made this move for startups to creatively look for financing, but also low interest rates has also made investors become a bit more curious of other solutions as well. Again, because of the 2008 financial crisis, interest rates have been very low, so investors have moved away from, say, government and corporate bonds, and have started looking for other alternatives. And in fact, this has benefited VCs, accelerators, and crowdfunding, among others, because of the higher returns they offer for these investors. So there is actually more. Well, I don't know about the at the moment with the effect of COVID, of course, but since sort of like 2009, 2010, each year the amount of capital available has increased for startups. And also, yeah, finally, government policy as well has been influential. Governments have recognized that and following on from the example made by Silicon Valley and all the big tech firms over there, other governments around the world have understood the importance of entrepreneurial finance, and this has led to many policy initiatives to make this sort of financing available. The European Investment Fund and European Investment Bank have been big on this in Europe, in creating and supporting instruments for entrepreneurs, along with enterprise investment schemes or seed investment schemes that allow high net worth individuals to receive tax breaks if they invest in high risk companies. In general, the solutions for and how I've categorized them for financing can be categorized into equity, debt, and grants. Some of them can be hybrid solutions in between, and each source of finance really has its own target, has its own approach, and has its own goal. And this is because companies in general go through multiple rounds of financing as they grow and as they mature. And each stage within the company's growth requires different strategies or types of finances, and we'll look at these. In fact, in this next slide here, this is quite a famous image on the finance escalator or the life cycle approach of the firm. So as you can see, we were here's this value of debt. We were in this stage where you say spun out of the university, and you're you've created your prototype proof of concept, and you're looking to commercialize it. And then here on the top we have the types of finance you might go to. Here are your revenues, and this is time. In fact, I mean, you could as well, it depending really on the sector that your company is in, the revenues might actually come across here to where it says say B, and you might not break even till then. Like an IT startup, might be able to make sales quite early, and will require the later stage finance to ramp up its sales and growth. But for example, a heavy medtech startup, might have a long pathway to even selling its first product, and especially not break even. So it might be a bit longer across here. But here we have as I said, the sources. FFS is founder, family, and friends. Angels. We'll look into both of these in the next slide. And then this A, B, C is sort of the stages of generally these are a series used in venture capital. And then as you see, as you get more and more profitable, you start gaining the interest of acquisitions or mergers. So these might be companies in the same industries who want to buy your company for a strategic reason. Here, I think they've actually missed a big player, but they're more looking to flip a company that's less profitable. Private equity as well might become interested, and then as you look to scale more, there'll also be IPOs, so initial public offerings onto the secondary market. But yeah, we're focusing on this very left side of this financing sort of life cycle approach. Yeah, I mean, as you can see, along your funding journey, you'll probably use multiple different financing instruments, and sometimes they might be used simultaneously as well. All of these different modalities should be, regarded as complements rather than substitutes. And yeah, each one sort of has its own target and purpose along the life cycle of the company, because obviously the needs of a startup change as they grow, and the requirement for capital as well increases as they grow. A Series B could even be, say, 100 million. Well, over here you might just require, 50,000 to do a feasibility study, or 500,000 to do your first prototype. Okay. So then, before choosing the source of finance, you should make an assessment of your positioning. So kind of where you are on that graph, where you are on your product development plan, what you require financing for, and how much you actually need. And this is very important, to plan, especially when you are speaking with investors. Having a plan will make you much more credible than just going out there looking for whatever you can get. In fact, planning we'll look at tomorrow. Instead, today we'll just look at the sources of finance available and sort of the advantages and disadvantages of each sort of finance. Okay, so we start off with equity finance, which might be the most probable and common source of finance for a startup. What is equity finance? Equity finance is the process of getting cash into the company or raising capital through the sale of shares. So you sell a portion of the ownership of your company in return for the cash. Generally, these are in return for ordinary shares. So ordinary shares are standard shares that have the right to the capital growth of the company. They have a right to dividends, and they also have a right to voting in the company. But there are also alternatives, for example, preference shares, which are shares with a fixed dividend whose payment takes preference over ordinary shares. So it's a bit of a hybrid in a sense, kind of like a debt instrument. The disadvantage here, of course, for the investor. Okay, the advantage is every year they get a guaranteed amount. Well, someone who's determined on dividends might one year get zero. But obviously, if the company does start to grow really fast and does really well, the dividends could become very significant, and the person with the preference shares might just be limited to say 5%, while the person on the dividend is getting 10%. There are also convertible preference shares that are an option that gives that are the same as a preference share, but gives the shareholder the option to convert that one day to ordinary shares, so then they can start participating fully with the dividends. Once again, there are different types of equity investors for different stages of the startup's growth. Depends on the amount of funds and risk appetite of the equity investor. But these generally include founder, family, friends, angel investors, venture capitalists, and another one that's been added quite recently are also family offices as well. So we'll look at the first one, which is the FFF, or the founded family and friend. And this is often the first one, or one of the first sources of finance in English. We also might call it bank of mum and dad. So this is when you have an idea, you might need some initial capital for your startup to set up your company or to investigate it. So you might ask your parents, ask your friends, and most importantly, you too might put that money into the venture. As these people are close people, they should know you well, and they should be able to make a clear judgment on the success of the business plan and you yourself. They should know if you're ready for it. And obviously, depending on the wealth of yourself, family, and friends, it also depends on the amount they'll be able to give you. I'd say it's very rare to see one above 50,000 really. Generally, they're sort of 5 to 50K, and they help fund the startup in the first year. Of course, a benefit of founder, family, and friend finance is that can be a cheap and flexible source of finance. So, firstly, there are no intermediation costs with advisors, internet platforms, or, for example, lawyers in building up contracts. Stricter contracts. You should always have a contract. And there'll be no marketing costs as well, so you won't need to travel to VCs or attend pitching competitions, or promote your product on a crowdfunding platform and pay for ads. And the amount you decide to return for the amount you decide to give the investor, that's up to you and the investor to decide. And depending on who they are, the founder, the family or friends might be quite kind to you. They might take less equity than a professional investor that will come in quite aggressively. And importantly as well, they might be a flexible source of finance compared to other investors. So they'll understand you, and they will give you a bit more time, say, to build your company, and probably will be less interfering in your vision and more supportive of your vision. So it's a good money to start with. But of course, the big disadvantage of family and friends is it mixes business with friends, and it can create tension between you and your family and friends. In particular, if the venture doesn't succeed and you lose money, you'll feel quite a bit of tension there. Or if circumstances change in the family and friends, and they might need the investment back, they might be able to send they can't really sell it until you find a secondary market or raise another round, and the VC might be willing to take it on. It's going to be difficult for them to get their investment back if circumstances change. It is therefore probably best to only target wealthier family members and friends who already invest, know the risks of investment, and can actually afford to lose the investment because they're coming in one of the first people at the start of your entrepreneurial journey, when you face the biggest amount of risks ahead of you. They may also not know the business well, and therefore can't really advise or contribute to the business in well, which is other forms of investors can do. But also consider that investment doesn't necessarily have to be in cash. It can also be in sweat equity. So that's the time people or you put into the investment. It could also be loaning a piece of equipment. So they could give you office space, or you give yourself office space, and you contribute some equipment or other resource to the company. Another one could also be saying intellectual property rights. So yeah, it doesn't have to necessarily be cash, be creative here. And in fact, for the founder, putting time and money into the new venture really is an underlying assumption. So yourself starting the company, you need to ideally put some money, and for sure 100% of your time into the company. And this is what other investors will expect to see. The assumption is, if you're not going to invest your time and money into the venture, why will any other investor? So when you start your company with you and your co-founders, a burning issue at the beginning is always how should the equity of the company be split between the founders and the early employees. Especially, this is especially tough if you're inexperienced or you and your founders have had a friendship before. Can create tension, and therefore many oftentimes the amount of equity that is then distributed is based on the titles and roles. So I'm the CEO, I'll take 40%, you're going to be the CEO, you take 30%, I'll take, and it eventually goes down to this. But the big risk of this is some founders at the beginning might put in less time than others, or they will put time in the beginning, then become less enthusiastic and will stop giving them time, or they might eventually leave. So just an interesting suggestion from Peter Lieberman that just thought I'd add in here was, he suggests that you equally distribute the equity between the founders, but keep an amount of equity not allocated. Say here, as you can see, he put aside 25%, and then in the case that during the first year, one of them decides to spend less time on the startup, then there's an amount of equity that can be then reallocated and distributed more fairly on the eventual enthusiasm or time that people put in. So it can be as a mitigation or it can be as a corrective action. Of course, there may be cases where an equal splits are allowed. For example, one of the founders might have actually brought the idea of a startup to the table, or they might, for example, take a lower salary, or they might, put themselves in the CEO position and take a significant or the legal director and be taking more risk than the other members. Okay, so now we move on to, you might have heard of these before, angel investors. Sometimes they're also called business angels as well. And these are private investors or individuals who actually invest their own wealth in early stage companies. They don't use any intermediary. They source the deals themselves, their network, and they privately invest themselves. Many of these angels, their profile is they've often got a good amount of experience in the industry, and they probably built up their wealth by going through previous other exits, and they're looking to reinvest their wealth in other potential startups. Sometimes the they invest together with another group of angels, and these are called angel syndicates or angel groups or angel networks. And these have become one of the most important sources of financing for startups, especially at the early seed stage. So when you're not yet commercial, but you need that financing to fund your development. And in general, they invest between, say, 10K and 500K. They might be doing this as well for a tax break in certain states. And if they're investing as a network, this investment could actually be over 1 million. There is another funny term out there. It's called a super angel or archangel, and this is given for an angel that invests above generally 250K, and maybe has gone through a big high-profile exit before. An important thing is, angel investors are generally, mid to long-term investors. They understand the cycle of startups and the length of time that this money will require to eventually, yield a return. But they are, they do look for good returns. So say at least 5 times their investment. Importantly, angel investors don't just bring their capital, but often, because they're from industry or have gone through other investments, they bring their years of experience and expertise to startups. They might offer their management support, for example, in strategy, marketing, finance, HR, but they also might open up their network to an early stage company. If they've been through an exit before, they might have a very, very good network and might be able to introduce you to other investors or maybe some customers or maybe some supply chain or distribution partners. And they also might require a board seat, especially if they're a significant or super angel. But later on, they might be, that board seat, they might be replaced with venture capital or another type of investor, bigger investor. Say. Okay. So here's just a few bits of data about angel investors to show you the importance of angel investors within the European ecosystem. So the size of the angel investment market in Europe, grew to 7.45 billion euros in 2008. It was growing about 3% on that year. So if it's growing again, we might be reaching 8 billion now. They're actually a significant portion of, I think about 30% of finance for early stage companies comes from these business angels. And the number of business angels in Europe is now estimated to be around 345,000 investors. And in 2018, these business angels invested in 37,200 companies. So they're very active out there. In Europe, in the US, this market is even bigger at $23.1 billion. Of course, as we said before, unfortunately, location does matter with business angels. So, within the visible market, United Kingdom continues to be the leading country for the amount invested by business angels. The amounts look slightly smaller here, but that's because this is the visible market of there's some hypothesis on the invisible market. And then, Germany comes in second, followed by Spain. And this is because business angels are generally keen to invest close to home. This is partly because each country has their own regulations on the startup ecosystem, You know, and there are benefits for businesses available. As I said, there are tax breaks for business angel investments, for example, in the UK with the Enterprise Investment Scheme. But it is also because many business angels actually invest through their network, through contacts, people they know. They'll be introduced to someone, and therefore, yeah, they, you know, they're more likely to invest in, say, a friend of a friend's company or someone within their city who they've been following. They often take great interest in companies within their previous sector before as well. So they might know people as well. So this is an important factor. Then it's also raising investment from business angels is also very sector specific. In Europe, you know, in 2018, the main sector was fintech, but also enterprise software was very important as well. I mean, the difference here is the actual amount in euros, and the one on the right is showing the amount of deals. But also, you know, health, mobility, and agri-tech have become very, very strong as well. So dependent on your sector, might also influence your chance on raising money from an angel investor. Yeah, and in terms of when angel investors invest, yeah, they generally invest at this seed stage to, you know, develop, yeah, the initial concept, and for sure before the company, you know, reaches profitability or start selling their product. Although, you know, this is very new that we're seeing angel investors also investing in at a later stage as well. But yeah, generally they will be your one of your first port of calls for financing. And then the time horizons that angel investors look for, you know, if they're investing at a very early stage of the company, they, you know, have a longer term vision or longer term investment horizon than other investors. And this is why angel investors have you know, got the nickname of called patient capital, where they're, you know, they're willing to hold their investment for a long time. And this, you know, this highlights the importance of building long-term relationships with angel investors. Yeah, another interesting point here is what do angel investors look for, and what are the sort of factors that serve as selection criteria for investors with angel investors. With 90% of them say that, you know, the most important, you know, concentrate on the quality of the team as the main decisive factor to start an investment. The idea and the growth potential of the company are of following importance, and the quality of the business plan also does remain quite significantly important. However, it is apparently, you know, considered as a factor that can be worked out as opposed to the key idea or the team setup. So they know that probably the business plan will change a lot. And, you know, new findings will be found especially in an early stage venture. So they're really looking closely on the team, and that's possibly highly influenced by the fact that they also invest in their network and often know the people they might be investing in. And then, yeah, among the factors negatively impacting the decision to risk is, you know, they don't like to see, you know, too many risks within the project. Yeah, for example, a high risk of failure. They also don't like to see exaggerated valuations. Yeah, here's an interesting one as well. The project was, you know, far from where worker lives, so, you know, that can be quite influencing on the business. And yeah, as they often like to invest together, they might often want to see other investments on board as well. Interestingly, yeah, quite small is that the project only has had low return potential. Yeah, this could be because many angels often see only invest in projects with high potential, so they don't normally actually see that that factor. So if you're approaching angels, you should really focus on making sure that there's not too many risks associated with the project. And finally, yeah, here's a list of market problems or risks that prevented angels from investing in startups. Yeah, so they like to see that market demand is proven. If it's not proven, that's a very big risk for them. They like to see, yeah, the competitive landscape. Again, the team is very important to them. So a lack of having like an entrepreneurial or good team to execute the project is, yeah, it's very influential on putting them off from investing. And then, yeah, I mean, I'll share these with you afterwards, but yeah, these are all the sort of things that need to be considered and overcome when presenting to angel investors. Okay, and then here's a bit of the role of the angel investor. For example, this is the example of an angel investor who has 12 companies they've invested in. If this really is the case, the guy must have made a lot of money and has probably left his job and is just angel investing full time now. But they spend a lot of time giving advice. So this is really one of the key things about angel investors, is that they can offer you good advice, and often it is very good advice because they've been through the story, the entrepreneurial finance and entrepreneurial story before. So this is something that's not equated to the equity or the actual amount that's given in, but is very, very valuable. Of course, they give this advice because they want to see you succeed as well. But yeah, they also might attend board meetings, be in operations, do introductions, so they can introduce you to their network, which is also very useful, and other sorts of activities as well. So those are the angel investors you might meet at the beginning of your journey. Another one you will meet at the beginning of your journey, and maybe just a little bit later on your journey. These often like to see a little bit of revenue coming in, is the venture capitalists. And this traditionally has been the most important source of financing for startups. Startups often seek, but unfortunately rarely obtain, venture capital finance. And venture capital companies provide capital equity in startup companies that have high and long-term growth potential. Venture capital plays an important role when the startup begins to commercialize its innovation. And around 80% of venture capital money goes to building the infrastructure required to grow the business. So for example, manufacturing, marketing, sales, fixed assets, working capital. Maybe it goes a bit less towards those development activities. It goes more to that scaling up and the growth of the company. Venture capital has a mid-term perspective. It's not long-term money. It's mid-term money. With venture capital companies looking to sell in about 5 to 10 years. Venture capital companies look to invest, in balance sheets or in the company and the infrastructure until it reaches its sufficient size and credibility, so that they can then sell it on to, for example, another corporation through an acquisition, private equity, or maybe do initial public offering. They're focused on high returns on investments. Venture capitalists look at the money, they want to see 5 to 20 times growth on their investment. Venture capital companies often invest in round. So they might invest in seed, Series A, Series B, Series C, with the amount of investment increasing over time as the company reaches new milestones. The value of the company increases and the risks are reduced. A typical Series A, typical seed might range around sort of 1 million to 3 million. A Series A might be sort of 3 million to 10 million. Series B, 5 million to 25 million, and Series C can go up to sort of like 10 to 100 million. There could go Series D, Series E, but they're not so common. But yeah, as it goes across the company reaches more milestones, it can raise more funding. As the funding size increases, its focus is more on scaling up the company, building up the company user base, rather than on say product development. Okay. Again, yeah, venture capitalists, like business angels, they don't just offer money; they also offer value-added services, so management, technological, support, advice, access to their networks, and often this means that the venture capitalist takes a board seat within the company. As I said, venture capital, is very popular for startups because their financial and business skill can play an important role in the startup success. As we say, the business angel has its purpose at the beginning, helping get it off the ground. But when the company starts growing more, it requires a different set of skills, and the venture capitalist can offer these skills. And good networks, that venture capital companies have, can also help commercialize the product and help bring on partners to test this as well. That allows a more flexible process to innovation. In addition, the venture capitalist investors may provide also legitimacy to the company, especially a very strong venture capital partner can serve as a good quality signal. So this brings about this concept of a venture capital company that invests, nurtures, and sells the company eventually over this time frame of 5 to 10 years. The popularity of venture capitalists means that startups remain private for longer. Before, in the 90s and early 2000s, it was a race for companies to do initial public offerings, but eventually many of them failed and created the famous .com bubble. But by growing the growth of venture capital, it means that the companies now remain private for longer, and they're not racing to do IPOs to raise money to grow and scale. The market and landscape for entrepreneurial finance has also changed over the years, and a new sector of venture capital has emerged, social venture capital. Of course, these companies are always focused on financial goals, as venture capitalists are very financially focused, but they also are interested in societal goals, such as deliver social impact. For example, they might be focused on increasing jobs for or female-led founders. They may be also looking at green goals or healthcare goals as well, and they'll then measure, as well as the return on investment, they'll also look at the social return on investment. Okay, so yeah, it's very high risk finance. Venture capital, as it's still investing in these early stage startups, and therefore it must offer attractive returns to participants in venture capital funds. Investors generally in these funds are like large institutions like pension funds, financial firms, insurance companies, sovereign wealth funds, high net worth individuals. They put a small amount of their money, their total investments in this high risk venture capital. And generally they expect, say, a 15 to 30% annual growth of their investments. And what leads them to invest in these funds is, they have trust in the venture capitalist track record and the partners. And yeah, these venture capital funds can offer very good returns to investors who go into them. They can also, obviously, as a very risky investment, they could also go flat as well. The difference with angel investors, as you can see, is that they don't invest their own money like an angel investor. They own and manage professionally other people's money. So it becomes more of a profession with angel investors. You could say they're investing more for fun. The lifetime of a fund is 7 to 10 years. Generally, the fund makes investments over the course of the first to 3 years. So when you see on the internet that a new fund is opening, within the first 2 to 3 years, they'll be looking to invest all of that capital. And then, within the next sort of 5 to 7 years, the investments are active. They're offering their advisory and helping investments, and maybe raising another fund. And then they're expecting to harvest their returns in the last 2 to 3 years, so at year 7, 8, 9. The venture capital funds are they usually like to take an equity position, a preferred equity position in the company, and this means that if the venture fails, then they'll have first claim to the company's assets. Okay, and here's a little diagram you can look at after this on how the venture capitalist industry, how venture capitalists fit within a larger model of entrepreneurial finance. So corporations and governments often are the first people funding entrepreneurs. Venture capitals then fund the entrepreneurs in return, for the equity. The venture capitals raise their money from private investors, such as sovereign wealth funds, and then eventually the venture capitalists sell their stakes to, for example, investment banks that do public offerings or mergers and acquisitions, etc. So that's how it sits on the overall corporate finance perspective. A few things. Venture capitals, like angel investors, they like to also invest with other investors. You often hear of lead investors and follower investors. It is rare that one venture capital firm exclusively funds a firm. They prefer to have 2 or 3 groups involved. This obviously increases gives them the ability to diversify their portfolio. In return, financing 1 to 2 years of a startup, this is venture capital. They are very focused on money. They can look to reap extraordinary returns at a relatively sort of low risk, providing they can exit the company and the industry before it tops out. Venture capitalists can expect to sort of get a 10% return of capital over 5 years. And the venture capitalists themselves, of the gains, investors usually see 7 to 80%, while the venture capitalists get to see sort of 20 to 30%. For investors, these fees are acceptable because the venture capital firm has provided a very attractive return on investments, which says 15 to 35% annually it's quite high compared to other forms of financing. However, yeah, getting venture capital doesn't guarantee success. If you do get it, your odds of failure are still very, very high. As described earlier, yeah, the odds play out also in venture capital portfolios. More than 50% of companies in the portfolios will at best return only the investment, while other companies will could make total losses. But given the portfolio approach and deal structure, only 10 to 20% of startups need to be real winners to achieve their target return rate of sort of 15 to 35% per year. Often you might hear of sort of the 80-20 rule or the power law as well. And this is where, only one investment can completely outdo all the failed investments, because it grows so strong and so highly. I mean, ideally, the investors should really only, or venture capitalists really only look to invest in companies that have the potential to outdo sort of all their bad investments. So they don't actually want to invest in companies that might do 5 times or 10 times. So when you're approaching VCs, or 1 time or 5 times. So when you're approaching VCs and presenting your business plan, you want to position yourself as that winner who's going to help them recover all their losses, because they know they'll make losses, and they want to invest in the winners. So actually, when VCs look to invest, they don't actually invest in these companies who perform 1 or 5 times per year. They only really invest in companies of 10, 20 times percent. So you want to position yourself there. Okay. So yeah, unfortunately, the results determines how venture capitalists spend their time. Funny enough, often, they don't spend time with the worst performers, but often venture capitalists also spend a little time with the real winners. They spend most of their time with the middle companies, deciding, can the investment be turned around? Is continued participation be advisable? Yeah, I mean, this is actually goes at odds with reality. They should actually be spending more time with the most successful company and just focus on making them as profitable as possible. But often they do want to decide what to do with these middle companies and whether they can turn them as well into equally successful ventures. So ventures, capitalists spend their time in the following activities: soliciting business, looking at opportunities, analyzing business plans, negotiating terms, serving as directors and monitors, acting as consultants, recruiting management, and having outside relationships and access in. So the image of venture capitalists as sage advisors is not often the case, really, because they're only 40% of the time is spent as directors, mentors, and consultants. And the more money they manage, the less time they have. This means that often the advisor, the venture capitalist you work with, is not actually that knowledgeable about your industry or technology, you will probably know more than them, but they will be able to help you on that financial side of the business. So they're very useful for that. I mean, they do often, without putting them down, they often come from very strong academic backgrounds, or so sort of an MBA, but also a strong industrial or investing background as well. But considering venture capital firms now manage a few million up to $1 billion, with the average size being about 150 million to 200 million, they manage sort of 30 to 80 companies. So they're very busy. So it's not necessary that you'll get that much solid advice for them. Traditionally, they were more like business angels. where their operating experience was valued, but now they're, let's say, a bit more like bankers. So what do venture capitalists look for? Well, they look for good ideas in good industries and good teams. So proven, successful people. So it can be considered a proven risk. They look to invest once technologies are more certain and market needs are known or less risky, but before the company is growing too strong and is consolidating the market. In fact, almost 80% of venture capital finance goes into the sort of adolescent growth phase. So once you've proven your product in this, but you need to make accelerated growth. And the rest of it is generally follow-on investments. Yeah, I mean, how do they tell the difference between a company they're going to invest in and a company that they're not going to invest in, especially if there is a product-starved market. First, they don't invest in a technology risk in an unproven market segment, so you need a proven market segment. They don't invest in the wrong industry. They only invest in good industries, and what we mean by this is that industries with above average growth. It's because it's a lot easier to make your money back in a market that's growing than one with low, no, or negative growth. Despite the innovation or the talent, of the startup or the charisma of the founder, startups rarely receive backing from venture capital firms if they're in a low growth segment. So it's important when you're presenting to venture capitalists to make sure that you show that your industry is growing. And so, for example, like growth industries at the moment might be like, for example, artificial intelligence. Is a huge growth industry at the moment. So if you're positioned in there, make sure you show that this is a huge growth segment. So that it increases their chance that they're going to for sure make their money back. And third, they obviously identify competent management. And in fact, if your technology is proven, you're in a high growth industry, you could say that the only thing the VCs then have to choose is competent management. So you want to tick those boxes. I mean, there is, the problem with venture capital finance is it is expensive. Many entrepreneurs are frustrated by what they see as an unfair deal process. But you've got to consider that there aren't that many sources of funds out there. So unfortunately, you'll have to give away equity on your entrepreneurial journey to be able to raise finance. And as we said, as a company matures, it just requires more funds than founders, friends, and family and angel investors can provide. So you need to look at these sorts of finances, and you'll need to prepare to give away these sorts of finance. Also, other sources of finance don't really understand the risks of these investments, while venture capital firms have a good understanding of the risk, and also they understand the principle of diversification. In addition to other forms of financing, venture capitalists are more flexible than other forms. They don't have restrictions on where you spend your financing, and they're more flexible on allowing you to commercialize your innovation. It comes as working capital. It doesn't come as restricted finance. However, and they also come with good networks and the association of being with a venture capital firm. If you raise from a good venture capital firm, you'll get press and you'll be able to highly raise your profile. Because if you're seen to be with a successful VC, it's generally considered that you'll be successful and they'll be more interesting within your product. Yeah, and here I just thought I'd include some questions. So at some point, you might come to the stage where the venture capitalist wants to sit on your board. This is good to have them on the board, but of course, having someone on your board can bring politics, and you want to make sure you have a fitting board member that follows your company strategy and in your company ethics. So here's just a number of questions. Don't let the venture capitalists do all the asking. It's a two-way process. It should be, it's 5 to 10 years, so it's a bit of a marriage, and you should make sure you're happy with the venture capitalists you're engaging with and the board. In fact, there's many venture capital firms out there. So if you really are that company that has proven technology in a growth market, a competent management team, then you might be actually in that lucky situation where everyone's trying to invest in you. And so you should also negotiate and find venture capital partners that can really help your company raise your profile and offer their experience into the company. So I just thought I'd include some facts about the venture capital, as it really is such an important part of the entrepreneurial finance journey. I mean, as you can see, since 2013, the amount of money in European venture capital finance is increasing. So it was about 28 billion euros invested in 2018, grown from 9 billion in 2000 and 13. Again, unfortunately, location matters. So really an important thing when you're thinking of starting your startup is location. Of course, with virtual technologies now, it's worth considering that you can open a limited company in the UK and live somewhere a bit cheaper and do trips over there. But then again, when you're there in the scene in these countries with a lot of venture capital, you just naturally make the network and the connections. It's very hard to make those connections when you're remote. So the European VC market is mostly concentrated in large six hubs: Paris, London, Berlin, Stockholm, Munich, and Oxford. However, new emerging hubs are also sort of shaken up, with 40% of finance startups located in cities with more than 1 million inhabitants, and 20% operate in smaller cities with a population of less than 100,000. Again, also sector matters. If you're looking to raise venture capital, once again, fintech seems to be the most popular one by far in Europe. So this is the number of deals. Security was also big. Marketing, health is also big within Europe. If you're going to venture capital, also consider the industry you're in. However, there's obviously still a massive gap in Europe in the amount of venture capital compared to the United States. As you can see, this is 2018. There was 135 billion and nearly 10,000 deals in the United States. And I shouldn't say this because I'm a big promoter of Europe, its values, and Europe becoming a tech leader. But location also matters. But of course, Europe is catching up, so it's also an equally attractive place for them to be. But this is why a lot of companies did move across to the US. The chance of getting funded was much bigger. There's another sector of entrepreneurial finance that's available as well, and this is corporate venture capital. This is definitely worth considering, particularly maybe for those very capital intense industries or ones with big barriers to markets. And these are corporates that decide to open their own venture capital branch and invest. Instead of acquiring firms, they decide hold stakes of firms and keep them independent. Again, they sought cash generally for equity, with the ability to further develop so allowing the company to further develop their product and markets. These might have like a strategic or technical objective as to why they're investing. For example, to access new technologies due to the fear of being disruptive, entering new markets, creating new customer segments as well. But for a startup, if you're considering this, the corporate network and potential, they can allow for a lot of, say, open innovation because you're connected to the corporate, or for potential joint ventures in the future. The one thing is, they are less autonomous than traditional venture capital, because they're driven by the politics of the corporate, and the capital available may depend on the financial performance of the corporate. But they are quite significant in Europe. Between 2007 and 2015, they range from 6 to 23% of the total venture capital in Europe. So they are a considerable market player. Corporate venture capital investments tend to be more impatient than normal venture capitalists. And for example, a number of these in Europe might be Intel does venture capital, Johnson & Johnson does corporate venture capital, Google does corporate venture capital. So it's more of a if you're strategically in an industry or market that they are interested in. Then there's government venture capital. So as a result of seeing the impact of venture capital, say in the US, many governments have started initiatives fostering venture capitals to alleviate the financial gap in their own countries. These may have more social policy-based goals, focus on job growth or social returns, so that stuff like green jobs, for example. And as policies differ from government to government, there's no standard to how they or what they invest in. But they might be more interested in regional development or localized jobs rather than young high-tech industries. So yeah, it's worth checking out what the policies are by the government venture capital. And yeah, these can invest in three ways: either directly through government-supported venture capital schemes to facilitate venture capital in regions. An interesting example like this is the European Innovation Council, that at the moment is in a pilot stage, but is going to be in full swing for the Horizon Europe. And they're offering grants, but they're also directly investing in startups in Europe. And this is the first time the European Commission will be doing something like that. Another example of this is, for example, in Ireland, there's the Enterprise Ireland. That's a government body that invests directly in high potential startups. There may also be hybrid forms where they co-invest with other private investors. In fact, an example here is, for example, in Europe, you also have the European Agent Fund. This is where the European Investment Fund co-invests with European angel investors, and with a nice incentive that if the angel investor invests, they co-invest, the angel investor gets a higher proportion of the gain from the investment. So it's to help encourage angel investors as well. And then often in funds of funds, so the government invests in other investment funds rather than investment directly into companies. And, a notable example of this is the European Investment Fund, and this is why I put the European flag here, because it's quite active in this market. And I think at that point, as it's 5 minutes to 11. I think I'll stop there. I've got one or two questions. In which phase of this diagram does government funding fall into, I'll just go back to the diagram actually. So let's see. Well, I mean, yeah, government funding generally is at this seed capital or early stage. But again, it depends actually on the government funding. And really, by looking at this, you should look at actually the amount of capital that's needed. So, it depends how much the government is offering. If it's 50,000 grant, then it's at the very early stage. So it's a feasibility grant, for example. If it's obviously in say 2 million to 3 million, then you're looking at the sort of A/B stage. So it's if you're you're doing product development and you're ramping up your sort of like the scale of the company. It depends as well which type of government, because tomorrow actually we'll do government grants. Government grants might sit in this sort of like seed capital and yeah, really in this valley of death is the grants before you break even. However, there are also programs now by government funding, for example, this government venture capital, for example, the EIC, that is now actually funding. They're putting up to 15 million into companies, and that sort of sits in this Series A, where they're looking to scale up the companies. Once the grant funding's been used. There are also other government schemes. So yeah, tomorrow we'll also look at debt. There are government debt instruments as well, but debt instruments also always generally look to have some sort of revenue to be able to pay off the interest and principal on the loan. And government debt funding can come in huge amounts. There's one, for example, one example from Innofin is up to say 75 million, and that's if you really need to buy a big piece of infrastructure or something like that. So yeah, it really depends on the form of government funding. Then what qualities within the founding team are important to angel investors? Yeah, well, often they'll actually look for the experience of the investor, and has the investor successfully either started or maybe been part of a venture before. So as we said, that offers almost proven success to the angel investor. But as we said before, they'll also look for commitment as well from the founding team members. So if you're doing a second job or something like that, although some might say, well, it's reasonable. I need to pay my bills, I need to eat, things like that. They want to see that you're 100%, you're committing all your time to this, and you're completely driven, because the startup journey can be horrible. You can go through patches where you want to give up, patches where you get rejected, you feel that the company's not going to make it, but they want to see that you believe, and that you're passionate and committed to the cause. Along with the usual things. You know the industry well. You have general business management skills. You're empathetic, so you can you're a good manager with staff and with people and relationships. But those might be the sort of qualities that they're looking for. So yeah, proven experience, but also commitment. Is there any difference in terms of financing for university spin-offs and ordinary startups. I mean, yeah, it depends what your relationship is with the university spin-off. So, for example, if the university still has, it depends what you relate. Yeah, are you licensing the technology of the university? In which case, you know, do you have exclusivity for the license and for the use of that technology, or do they actually participate in the company? Generally, no. Many university spin-offs become startups. Sorry, but sometimes the restrictions that a university might put in place might be off-putting for another source of financing. So, you know, obviously the patent not actually being your own or belonging to the university, you know, could be perceived as a risk by the investor, that might, you know, they might actually want to see that the patent's yours and that it's not dependent on external variable. You know, the investor might go, well, okay, what happens if you don't have the license to the technology anymore? You know, you could potentially, you know, that put in something that potentially, you know, you won't be able to have access to, or you might be investing into that technology only not to be able to commercialize it. If the spin-off is still part of the university, yeah, there might also be some possible funding sources within the university, similar to grants for example, PhDs, or grants for funding a specific piece of research. But really, if you've already proven your technology, you should look to, you know, creating an individual entity, that maybe a university would want to participate in as just a shareholder, and following you'd want to move off from that sort of university spin-off mentality, I'd say, and move on to the startup growth mentality, focused on commercializing your products and sales. Which sectors in computing are promising beyond AI? Yeah, I mean, I personally, you know, I'm dealing just with so many AI companies at the moment. That's why it came to me. But I suppose image recognition is also a very interesting area of computing that is growing. I mean, the internet is, you know, for a long time it's, you know, text-based, and it still is. You know, it is, the framework is still text, but images are becoming, you know, a huge image and video are becoming a huge part of the internet. Most of the content that's consumed or most of the content that's produced is image and video. So I'd say image recognition is also a very interesting sector of computing. Promising. I mean, people forever have been talking of quantum computing, but yeah, I don't think it's quite ready yet. Instead, you know, cybersecurity is always going to be and increased security is always a very growing and promising area as well, because you know, it's one, as threats evolve, we need better security, and with such a huge government regulation now and fines put on companies that participate in or you know, get caught out and have data breaches, or for example, you know, might also participate in or mistakenly participate in criminal activity. You know, the fines are, especially for financial institutions, the fines are in the millions, you know, hundreds of millions, if not billions. And therefore there's a huge potential there for cybersecurity companies as well. So yeah, that's but maybe I can come back to that one as well. But yeah, I'm just seeing it, you know, at the moment in the companies that I'm advising, and probably 50%, at least 50% are artificial intelligence. So, what is more important for Europe? More entrepreneurial ideas or more funding? I mean, I'm going to say this. It's funding. Statistically, I have to dig out the statistic. It's somewhere other, but Europe actually produces more citations than the US, which shows that there's a lot of good ideas in Europe, and there's a lot of good research coming out of university. Maybe not, a citation isn't an exact representation of an entrepreneurial idea, but I'd say it's a start. But for sure, more funding. I mean, there are so many companies applying to the funds. In fact, that one I said, the European Innovation Council, recently the success rate is something like in single digits, 1-2% of companies applying to that grant funding scheme are actually getting the money, which means that there's a lot of companies there that potentially are very good and maybe are overlooked or weren't evaluated or didn't present their idea correctly, but have a really strong entrepreneurial idea or good technological solution behind it. I mean, more funding for sure if we want to compete with America, and one of the biggest at the moment pushes from the European Commission is to start having more European unicorns. So these companies that create over 1 billion revenue, which I think there are only about 100 of in Europe, while in the US there's many more. I mean, if you look down at your computer now, a lot of the software that you have open is an American name, a European piece of software that you're using right now, and you probably come to difficulty or won't be able to name one. So as we saw in this picture, where is it? Here, I mean, in 2018, there was 134 billion of venture capital money plugged into startups in the US, while in Europe it was, including Israel, it was 28 billion. And considering the population of Europe is something like I think 400 million, and in the US it's 310 or 320 million. There's a very big gap there. So for me, I would say we've got the ideas. Maybe we could be more say ambitious with our ideas, like our American counterparts who are very self-confident in their ideas. But for sure, there's a funding gap in Europe. And I think that's all the questions. I don't know, Annette, am I missing any questions, or there is a chat? Yeah. Oh yeah. Again about slides. Yeah, I'll make slides available tomorrow after I finish the course. Okay. So I suppose at that point I will stop, and we'll see you all tomorrow. So tomorrow, I didn't actually finish everything I wanted to go over, but we'll go over debt funding, grants, alternatives such as crowdfunding, and then we'll look into how to decide how much money you need, and sort of how to tips and tricks in best presenting your idea and standing out from the crowd when approaching investors or other sources of finance. Okay. Thank you.